People have been talking about a bubble forming in the S&P 500 for a long time now. And as with any other asset price bubble prediction, there is a lot for us all to be humble about, because if the course of history in the financial markets has taught us one thing, which has never changed, it's that making predictions is generally best left to fortune cookies. And so this video isn't me trying to call a top, or even me saying that the market will definitely crash soon. The truth is, nobody knows for sure, but I feel that it is reasonable to try and look at the arguments and the data on both sides of the coin, and try and be as objective as possible in trying to figure out whether the S&P 500 is in bubble territory, or whether it actually reasonably reflects the low interest rate and highly liquid market that we are living through right now. So to figure out whether the S&P really is in bubble territory or not, we need to set a standard for what an asset price bubble actually is so that we are all on the same page. To me, the most rational and simple definition of a price bubble is when the price of an asset rises to unsustainably high levels, where a correction of some kind isn't just likely, but it's eventually unavoidable. And from this very basic perspective, it could be easily argued that the S&P 500 isn't in a price bubble, because the matter of the fact is, even though you or I as retail investors can't borrow for 1/4 or 0.5% per year, there are a lot of big players who can and are borrowing for in many cases well under 1% per year. And these players represent a fairly large portion of the capital in the market, and when we consider that the earning yield of the S&P 500 is around 2.5% per year right now, the cost of capital in terms of interest on borrowed money for many people in the market is substantially below that rate of income for the S&P 500. And whenever there are a large number of people, or rather a small number of people who represent a large percentage of the capital in the market, who can borrow at rates of less than half of the rate of the earnings on a fairly predictable income stream like the S&P 500, there is a very strong case for the market not being in a bubble, as prices are not unsustainably high for these people. And if I can secure $100 million at an interest rate of 0.5% per year, which is fixed for a long period of time, and I can get a 2.5% return on the S&P 500, it is still a viable deal. And I for one actually think that the market has almost been divided into two tiers, one being those who can borrow for ultra low rates and those who cannot. It's always been the case that wealthier people and organizations have had access to better interest rates than most people, simply because of their stronger financial position. But never before have we been in a market where there were some who are borrowing at 0.25% per year, and others who would struggle to borrow at 4 or 5%, which even still in many areas wouldn't be considered to be a very high rate of interest. And even though the nominal difference doesn't seem as if it's very much, it's not the nominal difference which actually matters, it's a percentage difference in the cost of capital which is important. If you can borrow at 0.25% per year and I can borrow at only 4% per year, your cost of capital is 16 times cheaper than mine. In other words, you could potentially finance deals with borrowed capital up to 16 times cheaper than I would. That just couldn't happen if the prevailing interest rate was 5 or 6% per year. And as the interest rate has fallen, the cost of capital for the rich has fallen in comparison to the average, which may mean that the S&P 500 is still a viable investment for some, but not for others. I have sold my entire S&P 500 holding for the simple reason that the alternatives available to me personally are far more attractive, considering that the S&P 500 was yielding an income return of around 2.5% annually. All I needed to do was beat that rate of return by a large enough margin to cover the cost of rebalancing. And rental property here in the UK, or real estate as you guys in the USA will call it, which I also invest into, offers a return of easily double that of the S&P 500 on a net basis. And so I'm now earning a return of around 5% on the capital that I used to hold in the S&P 500, which was returning less than half of that. And so the situation is clearly different from investor to investor. Some people may have alternatives available to them which offer far better returns, with a similar or even lower level of risk. But for others, they may not have anything better available, or they may not be in a position to invest into any other asset, even if the returns are on a risk-adjusted basis better. And even more dangerous than holding an asset which seems to be a bit expensive relative to the alternatives, could be holding cash and government-issued currency in large quantities at a time where quantitative easing and the inflation of the supply of money is destroying the value of that currency, and eroding the value of portfolios which hold significant amounts of cash. Investing has for the first time ever become a mainstream topic, and it seems as if everybody is an investor in some way or another. But I guess that we can't complain because we are all in the same boat and we all want to improve our financial positions and we are all trying to build portfolios to help achieve that end. But nevertheless, one of the impacts of a market where nearly everybody is investing is that yields will fall. And that presents us with two options. We either wait and hold cash until we find opportunities which are more attractive, or we continue to invest, and both options carry their own risks and potential rewards as well. But anyway, that's all for this video. If you enjoyed and you'd like to see more content like this, then be sure to subscribe to the channel and turn on post notifications for those videos. Thanks for watching.